Hello, everyone. Thanks for attending again on our great podcast. And my special guest is Richard Advani from Supreme Lending. And today we can talk about uh, today's skyrocketing rents, merging up with how real estate investors will take advantage of this seismic shift in this real estate market, and how mom and pop real estate investors can really do well in these challenging times. Anyway, so my name is Yi Yi from the Yi Real Estate Network. So without further ado, let me share my screen and let's get it started. Richard, how are you?
Great.
All right, excellent. So here we go, and let me do my slideshow. So here we go. All right, landlords profit from historic skyrocketing rents and bidding wars from renters. And really, again, this video is for highly motivated, committed real estate investors. A lot of you are mom and pop investors that want to create a real estate portfolio to achieve financial freedom. So this is, as far as I'm concerned, is a blueprint. What we're going to show you is a blueprint for real estate investing success. So now, before we go any further, most of you should know who is Warren Buffett. He's one of the greatest investor in modern U.S. history. So one of the quotes that he did right after the Great Recession back in 2008, he said, "Be fearful when others are greedy, and be greedy when others are fearful." So right now, a lot of people are fearful. That's why in times of crisis, us real estate investors, you should be fearful. I mean, you should be greedy. I'm not saying greedy in a negative way. Greedy in a way that you need to focus on your personal financial wealth building and be greedy about it and be courageous about it and take action to see, and you can change your financial life for yourself and your family for generations to come. So let's go over what's going on right now. During the pandemic, and even before the pandemic, there were a lot of bidding wars and multiple offers on home purchases all over the country, as we. So now, now we're seeing bidding wars for renting. How the script has flipped. Oh, by the way, Richard, you can interrupt me anytime. If you
I mean, it's such an amazing thing to hear and see as a landlord. And, anyone who listens to any sort of news has been hearing it everywhere, right? Bidding wars for renting properties. I mean, that's that's music to all of our ears as investors, as you can imagine. And most of us have already seen this happen in the last year, and it continues to happen, dramatic increases in rent. But yeah, please continue.
Oh, absolutely. I truly feel as a real estate investor, especially mom and pop real estate investor, landlord types, right now is the greatest time to invest, which is sounds counterintuitive, but you need to be a contrarian investor. Okay, whatever the herd mentality, right? Everybody, the blind leading the blind, everybody going one way. The herd mentality. You, as a smart real estate investor, you need to take the contrarian view and go the opposite direction. The principle of real estate contrarian investing. Right, Richard? All right. So here's another. Let me be a little bit technical just for one moment. Okay, this is critical. Okay, you have to understand the numbers. Uh, I know I can spend hours to talk about many real estate investors numerical metrics, cap rate and cash out, cash return, ROI, and all those kind of things. But let's keep it simple today. This will be a very simple, short presentation. So one thing you need to know right now is rent to value ratio. Ooh, I kind of misspelled it. RTV, rent to value ratio. There's a typo there. Ignore that. Rent to value ratio, RTV. So let me give one example. A typical single family home rental property, one could buy average price, like 250,000. So the ratio, like a little bit less than 1%, anywhere from 1% to 0.007%. So use your calculator, multiply 250K by 0.007%, and your monthly gross rent should be around 1750. At 25% down payment, even with a 6% investor interest rate, give or take, you will achieve monthly positive cash flow. So this is the blueprint. So since Richard, since you are a mortgage loan officer who does financing for investors in all 50 states for many, many years, have thousands of borrowers doing the loans. What are your thoughts about this quick numeric I just went over?
Well, it's obviously the market has changed quite a bit, and the rental market's changed quite a bit. And I can honestly tell you, based on my experience, these figures you're giving are pretty accurate. We're looking at a lot of the homes that we were all buying in the high 100s and low 200s now are in the mid to high $200,000 range. The good news is, we've been discussing is rents have gone up with that. On average, though, I would say, yeah, the $270,000 property is going to rent for, 17 to 1800 a month. In these strategic markets, obviously that C Wing and I work with, and then some of the properties go up to around 300,000, and those ones also are bringing in 21 to 2200. So still really at that 0.007% range. And I'd say this scenario is a little more applicable for either new construction or strategic assets in growth markets like the Texases and Carolinas or whatever they may be. But yeah, it's a pretty good accurate representation of where the cash flow versus purchase price kind of falls today as well.
Yep, and numerically things should get better. We will cover. We will talk more about it in terms of skyrocketing events. So anyway, so the next thing is well said, Richard. So next one is investor landlord. You out there gets quote unquote pay to borrow money, end quote, at negative interest rate. And you, of all people, this is you in the mortgage business, you know exactly what I meant by negative interest rate. So please clarify to the audience why what I just said. Investor landlord gets paid to borrow money at negative interest rate. This is mind-boggling. So Richard, can you elaborate on that?
Yeah, absolutely. First things first is, obviously, the paid to borrow money part is the fact that the tenant's actually paying our mortgage, right? And they're paying the interest of the mortgage, not us really as the landlord with that rental income. Now, the negative interest rate, if I get what you're saying correct, obviously is, whatever you're borrowing at, the difference between that and inflation is still quite dramatic. So, even if you're borrowing at a 6%, 6.5% rate and inflation is 12%, you're borrowing 6% really under the cost of money and under the market. And it's that hedge against inflation as well. So, more so now than ever with inflation kind of going rampant, there's this delta between rates and obviously what that inflation rate is, which is really, it could be viewed as a negative rate, and it really is a wealth builder. Typically when our rates were 4.5% on rentals even last year, well, inflation was 2%, right? So there was the opposite delta that we're experiencing today. That delta kind of hurted us a little, whereas today's, most of the people are super scared because values are up and rents are up, rates are up. But what a lot of them are failing to see, which you've kind of demonstrated here, is, well, rents are also rallying up. Don't disregard that. And then when you factor in inflation, you're really not borrowing at 6%. You're borrowing probably at 0 or less. With where the inflation rate is. So
absolutely, very, very important, very, very important philosophical concept. Investors need to digest. So very well said, exactly what I expect you to say. So very, very powerful comment. Okay, let's move on. Consequently, the investor slash landlords, the 30-year fixed rate you're getting, it'll quote unquote go down in value. So hold that thought. We will cover a little bit more about that. What we mean by the owners, the investors, 30-year fixed rate mortgage will go down in value. So hold that thought. And then the investor landlord do not pay their mortgage debt. Wow, what other investment asset class in the history of the world that allow you to do that? I don't know of any. So, wow, you as an investor landlord are sitting pretty for the foreseeable future if you understand what we're trying to say. So this is amazing. And whenever there's a so-called crisis, there are opportunities, and the kind of things that we're talking about is really an opportunity for those who have the wherewithal to take action and to pull the trigger while everybody is doom and gloom, fear-based type of environment out there. So, okay, anyway, the investor landlord wins, and you guys, I hate to say winners and losers in this pandemic realistic world, but the investor landlord, mom and pop landlords, you are the winner. Clearly, you're the winner, not just right now, but for the foreseeable future. And I hate to be so blunt about it, but a lot of people are losers. I mean, I hate to say that word. Anyway, let's digress. Let's go on. So, investor landlord will outsource their obligation of debt payment to someone called the tenant. Wow, the tenant gonna make you wealthy. So 33 to 40% of tenants' paycheck gets to pay to you, the investor landlord. So Richard, you do investment loans all day long, all these years. So tell me what I just said. This two paragraph. I mean, what are your thoughts on it?
Yeah, I mean, so kind of what we discussed a little earlier as well. At the end of the day, you're not paying that interest. The tenant's obviously paying the rent, and in turn, the tenant's actually paying the interest for you on your real estate acquisition, which is beautiful. I mean, even better too, you get to write off the interest against your income too, right? So that's compounded even greater in terms of the benefits. And then of course, typically on average, we are looking at 33, 40, 42% of the tenant's income going towards, paying you and you paying your mortgage. So, if you look at it really, and look, as you said earlier, we don't want to say, people who are losing and not making the most of this market, but let's instead talk about who's winning, right? It's sad that obviously tenants are paying 30, 40% of their income towards their housing, but, us as landlords obviously are on the collecting end of that. It puts us obviously in a great position. And a lot of the markets that, we deal with have a very high renter concentration. And for a lot of people, that's actually turning into a choice thing. They want to be flexible. They want to move around. It's kind of a millennial and Gen Y. I don't know what the next gen is called, but whatever the next gen is called, they don't want those anchors and they don't want to be tied down quite as much. I've read articles, I'm sure you guys have all read them, right? The American dream, buying a home, still alive, and all this stuff. And I look at that, I'm like, hopefully not, right? Hopefully don't buy homes. Let us investors buy the homes and you can rent from us from the rest of your lives. We will take that. But that is kind of, what's trending. And a lot of it's not because investors are buying everything up. It's because primary home buyers, although there's a good chunk of them, I think, the sentiment kind of has changed, right? From, your primary home being this huge wealth builder. And although it has been for some people in the last 6 or 7 years, but that leaves a huge opportunity for us as investors.
Yep, absolutely true. Absolutely true. All right, so skyrocketing home prices, especially during the pandemic and even before the pandemic, we've seen some nice growth all over the country, especially in good areas. Skyrocketing home prices and a higher interest rate has caused a 40-year low in home affordability, exactly what we talk about. So let's go over the outline on here. Right now, we are experiencing a historic renters nation. You and I have been doing it for several decades in real estate investing, Richard, and I have never seen so many renters than ever before in American history. So this is a record-breaking, historical, is epic. I don't know what other words you can say it. More and more people will be renting, not just now, but for many more years to come. And that bodes well for real estate investors that owns nice homes in good areas. So we can rent it. We can rent it to a high quality renter, where they believe, as a renter, they believe the home is their center of the universe, and it is. So anyway, let's get back to the real world, the national rental crisis that we've been hearing recently. I mean, you and I live in California, Richard. So I live in Northern California. You live in Southern California, and look, people in my area, in San Francisco Bay Area where I live, and you in Southern California, we're hearing people renters are paying $4,000 to $5,000 in rents, not just in San Francisco and LA, but in New York City and few expensive markets. I mean,
that's in the suburbs now, not even in the metros. I mean, I own homes in suburbs in California that, I mean, you never would have thought rents would be $4,000 or $5,000 a month. I mean, that's what the metros, in LA, near LA, OC, now you go out to the Inland Empire and you're paying $4,000 or $5,000, a month in rent. It's crazy.
Yes, it is. I believe it. Same here in Bay Area, right? $4,000, $5,000, $6,000. I mean, in San Jose and San Francisco and a few other areas. It's just totally that. This is just record breaking. Now, and then let's look at the another region, the typical average rent. Now, we all know there's no such thing as a national real estate market. Real estate is very local, not only down to the metro, not down to the county or city. It's down to the specific neighborhood. It's down to the specific block. That is real estate investing. That's the real estate market. So anyway, the medium rent range 2,000 to 2,500 are typically or in the Sun Belt markets, South and Southeast U.S. Ideally, because the price of a single family home rental property is around $250,000 to $350,000, give and take price ranges. So this is what we see. So we have to look at the numbers, and then why you ask, I know you and I know the answer, but I'm going to ask the audience. Why are you saying in the South and Southeast for 2,000, 2,500 on a home price is 250 to 350, where we can see there's a positive cash flow situation? And why not Sun Belt in Southwest locations like Boise, Idaho, or Las Vegas, Nevada, or a couple of places in Utah or in Phoenix, Arizona? Why not in those locations, right? So briefly, Richard, can you tell the audience why the numbers, even under this scenario, why not in turnkey investors, mom and pop real estate investors, why not buy single family home houses in a Southwest Sun Belt location, such as in this location I just went over?
I'm sorry. So you're asking why someone wouldn't buy properties in those areas?
Why the numbers are not as good as the numbers, the cash flow numbers, rental value, and cap rate. Why by this region, South and Southeast, giving the rental monthly rent?
Yeah, I mean, I think it really comes down to that income, right? Most of those Southwest Sunbelt locations, firstly, have experienced rapid growth. And it's, although you can find homes in the 250 to 350 range, it'd probably be a little difficult to find a good quality asset. But, the rents, I don't think have really moved quite as much in those markets in proportion to the prices that we're seeing in a lot of the Sunbelt markets, right? We're seeing, 40%, 30% increases in the Sunbelt areas. So homes going from the low 200s a couple of years ago, now selling in the, mid 200s to the mid 300 range, but rents have moved up appropriately, and if not, sometimes even more than to make up for the price increases. Whereas, you know, rents have gone up, I feel like, in those other states, but prices have really gone up as well. And part of that is, you know, the West Coast migration,
Yep.
right? A lot of people are bringing California money to Idaho, Nevada, Utah, Arizona, and you know, when you're leaving an area where the median price is $1 million and you're going to an area where the median price is $500,000,
Exactly.
you know, there's a lot of buying power and people are less price sensitive, and obviously with all that demand, that's really pushing up the prices in areas like that.
Yeah. Yeah.
So they
Exactly.
make great markets to go buy a primary home in if you're going to move, but you know, not quite as good. And I'm not saying they don't make great markets or good markets for investment, but they're not going to generate the returns, at least currently in this market, that you're going to see in the Sunbelt markets.
Yeah, I agree. So my quick recap on this is the $2,000 to $2,500 monthly rent on homes of 250 to 350K, or basically in Texas, Florida, you know, North Carolina, Georgia, and a few other places, and not necessarily in Idaho, Nevada, Utah, Arizona, because the median price of single family home in those Sunbelt Southwest locations, or like you said, 500K. You cannot buy a 500K single family home, and the rent is only like 2,000, 2,500. You know, the rental value just does not make sense, and a cap rate and all that, and cash on cash return does not make sense. So, again, that's why my turnkey properties are mainly located in the south and southeast. Anyway, so let's go on. And the last region where real estate investors should really would do well is in the Midwest, you know, otherwise known as the Rust Belt. I know in Rust Belt area, homes are very, very cheap, comparatively speaking, but you know, it's mostly much older homes. So, you know, some investors does not like to buy older homes, even though some of the older homes can be rehab properly, and if you use the right turnkey provider in the Midwest, you know, even buy much older homes a lot cheaper, you get higher cash flow. So that's, you know, pros and cons to everything else. But in terms of strictly numbers, you know, if you buy a property in the Midwest, and there's so many areas, I'm not going to go into details. A Rust Belt area, you know, you can buy homes that are much older. Like I said, price range is 100 to 249K. They could be a single family home, duplex, triplex, or even a fourplex. So for under this range, and the monthly rent, gross rent, like 1,000 to 2,000 based on those price ranges. So therefore, you get higher cash flow to the tune of 1% rent to value ratio, but the appreciation and the quality of the homes and the tenants are not as high. So, you know, again, so in my mind, for turnkey risk investors, either you buy high quality, newer homes in the south and southeast, with a combination of cash flow and appreciation potential, or you know, you can diversify as well into buying Midwest type properties for higher cash flow, lower purchase points, and so forth and so on. So so that's, you know, that's my definition of asset allocation, dollar cost averaging as you call it, when you create your own real estate portfolio, Richard. So anyway, let's go over this next few slides, just kind of validate what we are saying, that the skyrocketing rents are finally caught up with the skyrocketing housing prices. So this two, you know, this two measure really bodes well with mom and pop real estate turnkey investors. And I have to say that right now is the best time to be a real estate investor amid all the chaos out there in real estate world and the economy, what have you. So rising rates, as you can see, you know, skyrocketing rounds rate. Like, look at this. Many cities in the southeast and southwest, rents have been skyrocketing 20, 30, 40, 50%, which is shocking. So look at the Sun Belt, right? I mean, look at Miami, 53, 55% increase of rent year over year. Orlando, you know, Tampa, St. Pete, just go over a few other areas. And I'm just pinpointing Florida because personally, I'm all in on Florida, you know, more so than other areas. But anyway, so as you can see, double-digit, triple-digit rent increases, and And finally, if you look at the high level, the future growth, job growth and population growth and migration due to the pandemic and remote work and all that, people are moving away from the coastal high cost areas, heavily populated areas into suburban areas, affordable areas, warm weather, a lot of amenities, good lifestyle and everything else, which is, as we know, as you and I know, into the Southeast and Southwest. That's the future of growth. So just a quick generic example, Richard, I mean, I know these numbers are quite hard to understand. The number is kind of small. So a sample of a typical Southeast type of property in Florida, Texas, or wherever, you buy a new construction, for example, or recent resale for a mere 233,000, for example. This is a real case, by the way. There's no need for mention the city, just the big region of Florida, Texas, North Carolina, Georgia, just to name a few of the hot and coming, fast emerging markets for real estate investors to plug their money. So at 233K, so you have 25% down payment, the monthly rent like $1,750, and then even with a 6% interest rate, mortgage interest rate, even with a high 6%, you can still cash flow for $236 monthly cash flow. And so if you look at the numeric metric, is like almost 1%, 0.08% rent to value ratio. So, and cash on cash return, cap rate, everything looks very, very good. I'm not going to go over the details, but as long as you can cash flow a little bit, few $100s, given what's going on in today's what is the market and the economy, even with high interest rate, so it'll carry you over, and the skyrocketing rents are lagging behind housing prices. So we are beginning to see. I track the rental market on a daily basis, and this 1750, out of no one can predict the future. Every market is different, every neighborhood is different, but this 1750 could very well go higher. How much we don't know, but this is the beginning upsurge of the what's going on with that skyrocketing rents. So this cash flow monthly may seem low to some people, but it's not going to stay the same. We will expect to see cash flow will be higher as the market balance out itself, and then we'll see skyrocketing rents of people that cannot afford to buy. So this is one example. Another example, a real case example, same place in Florida, new construction for 249 up, and I look at the rental meter. This software that I use, Rent-O-Meter, I subscribe to it. It tracked, based on a specific neighborhood, it tracked the square footage of a house, and the three-bedroom, for example, within the 2-mile radius. What is the average rent on this type of houses in neighborhoods? So this house is like listed as 249K new construction, pre-construction that is, 25% down payment at 6% interest rate. Look at this. The skyrocketing of rents has reached this particular marketplace. The rent that I saw on the rental meter is around $2,200 to $2,300, which is mind-boggling, right? So an investor put down 25% down payment, minus 6% mortgage rate and debt obligations and taxes and monthly insurance, property management fee, and all that stuff. Look at this. This number is just mind-boggling, especially in today's situation. Monthly net cash flow is more than $600. Imagine if somebody buys this kind of property now, later on, when the interest rate decrease, hopefully, right? We don't know. And when the Fed rate decrease the interest rate, you tell me more. What's your projection about the interest rate fluctuations? What about next year or the following year? If the interest rate for investors decrease from 6% to 5%, or even 4.5%, imagine what this cash flow can look like when an investor refinance the loan. from current 6% to whatever lower rate, I mean, the cash flow will be even much more phenomenal. So, all right. So, what are your thoughts? And then let's finish up, okay? And I want your thoughts, Richard. But you and I are always come back to this, okay? Most people don't know this, especially newbie investors. Okay, income property, especially single-family homes. Yeah, we can sprinkle in some duplex, triplex, and fourplex. So 1 to 4 unit is pretty much my philosophy of buying for myself and my turnkey investors. There's more than one way to make money, right? Income property, especially single-family homes, history is most powerful and proven, most tax efficient, multi-dimensional real estate asset class in the history of the world, and there's no asset class that comes close to it, because there are multiple ways you can get paid. It's not just cash flow, which is income. It's tax benefit depreciation, long-term equity growth consistently, and then leverage and using loans, using the power of the 30-year fixed rate mortgage. So that is my recap. So now, Richard, just give me some long drawn out thoughts you have from the last 2 slides that I just presented.
I mean, my first thought is, can you send me some information on that last example? That definitely was appealing. I know, but seriously, please send me an email with information on that market. But I think, your last couple of slides have really, kind of proven that there still are exceptional opportunities across the country. Yes, rates have gone up. Yes, property values have gone up. And everyone's really focusing on those, but don't be blind to the headlines that rents have gone up too. More, 50% in some of the Florida metros from year over year. That's nuts. And look, a lot of the price increases and a lot of the rent increases are also tied to inflation, which is why we always talk about inflation being such a wealth builder. That's why, in one of the earlier slides, you talked about negative rate, the difference between the rate you're borrowing and what inflation is. So inflation is such a powerful wealth builder. And, inflation, I think, to the newer generation is kind of a new and foreign concept. They're hearing it everywhere. They're experiencing it now. So they know, they're starting to understand what it is. But inflation's been around forever. Right? Inflation, normally they say 2 to 3% a year, but even taking that means a decade from now, something you buy is going to be, 30% more expensive at 2 to 3% a year. 30 years from now, it's going to be 100% more expensive. And that's at their 2 to 3%. What we've been experiencing the last couple of years is 10 to 15%. And that's kind of why we've seen those rapid increases in rent and in property values. It's supply and demand. Yes, that's one factor, and then also inflation's another factor. So, any of us who've owned real estate for a little while now, or even bought a year ago, 2 years ago, the wealth building effects keep getting compounded and compounded and compounded. And you hear we're in a housing crisis and rents are through the roof, and normally the kind of headline would give someone some sort of anxiety, but for all of us, we're like, yes, So yeah, I think as you always say, and as the saying goes, buy real estate and wait, don't wait to buy real estate. And if from even 6 months ago till today, you've lost out in growth, appreciation, and wealth building. And more importantly, you've lost 15% of your money sitting in the bank because of inflation. And we're in a unique part of the economy and in history where not doing anything and sitting on the sidelines is going to cost you more than taking an investment with some sort of a positive return, right? Even if it's 2% positive, well, you're saving from losing, 8, 10, 12, 15% in inflation, and you're gaining 2%, so that's, 15% return, so you got to look at everything broadly. And you also, the last piece is real estate riches and wealth are not generated overnight. They're not generated in a year or two. Yes, you can have some slam dunk deals and do well, or generate an Airbnb with a lot of income, but for 99% of us, our real estate riches have been built over time. It's buying and waiting 5 years, 8 years, 10 years, 15 years later. That's where the wealth comes from it. And, go into it with that mindset as well, especially if you're younger. You buy a property at 25, 20 years from now, when you're 45, probably be close to paid off, will be worth a lot more, rent will be higher. And, will just keep compounding for you.
Wow, you cover a lot of things in just a couple of minutes. I mean, there's really nothing for me to add. I mean, your words are powerful. You have wisdom, you have knowledge, you have perspective, and it's all about taking action. And just so many people out there sitting on sideline, they are fearful about the housing recession. I don't know what this term comes from, housing recession. I never heard of it, and I've been doing it for 20-something years in real estate. Well, you and I have been doing many real estate cycles. There's no such thing as a housing recession. The news media, mass media, that they have nothing else better to do but to keep on coming up with the scary headlines that prevent more people from investing in real estate. So that's very sad. But you and I know what's going on, and our powerful message is that take action. Right now, especially. Despite all the doom and gloom negative headlines, because you gotta have a lot of courage. So I'll say this one thing as we end this video, is that everything you want in life will happen if everything you want in life is on the other side of fear, FEAR. So with that said, that's all I have to say. Thank you for watching, everyone. Hopefully this message is powerful enough for you to have a lot of courage to take action. Thank you so much, Richard Advanny. You've been great. Supreme Lending. Have a nice day. My name is Si Wing Yi from the University Network. Have a nice day. Bye-bye.